No, this is my material, TikTok. So I'm gonna keep going, and then we're move forward. So if you now have the understanding of that, you start putting your money into other places where your money is getting better interest. All right. So now you understand that if you put your money into a checking account or savings account, with point 0.5, it's really only there. So that money's only should be there. That's going in and out. All right. That's going in and out. It's not there to be saved. All right. So now that you understand that, you say, okay, you know what? I need to put my money somewhere where I can get a better rate of return. So you put your money somewhere where you're getting 4%. Okay. And typically 4%, you can get a high yield checking, high yield savings, um, or you can get a CD or something like that. So it's always better to get a better rate of return. So now you have your money in a 4% interest rate. It takes 72 divided by 4 is 18. So the same $10,000 that would take 72 years in a regular 1% or lower point 0.5, your money's double in 18 years. All right, so let's keep going. All right, so now that you understand that part of it, all right, and if I'm going too fast, let me know. But TikTok's like giving me some issues saying that this is my information. It clearly has my logo on it, and this is a basic equation that anyone can put together. All right, let's keep going. All right, so now that you have your money in somewhere that you're getting typically 6 to 8%, what is usually getting 6 to 8%? That's like stock market exposure, S&P 500, etc. And this is education for educational purposes only. If you guys do want someone to do a strategy with you, I can definitely help you out. Send me a direct message. All right. So same thing. You have your money now growing in an 8% interest rate. 72 divided by 8 is 9. So every 9 years, your money's doubling versus if you have it here, getting 1% or point 0.5 where it doubles every 144 years. All right. Now I want you guys to look at what the banks do with our money. All right. Now, let's say now that you understand that you're getting 12% on your money, 72 divided by 12 is what? 6. All right. So the same time it takes you to make 40,000 with your money at a 4% interest rate, and you should at least be doing that. All right. At the same time, you make 640,000 if it's in a 12% interest rate. It's ridiculous. It's crazy. So now that you are seeing this, where do you have your money? Most people have their money in the checking account, in the savings account. Why do we have our money there? Because it's safe, because it's easy to grab. All right. You know, you can go to the ATM, you can grab it, but it's not doing anything for you. All right. So if you could put your money somewhere, where would you put it? It's kind of an obvious question. You would put it somewhere where you can get 8 to 12%. But if you're on here and you're watching this and you don't have a checking account, getting at least, getting at least 4%, then you need to ask yourself, like, why are you not doing that? All right. Why are you not doing that? You can go SoFi, Betterment. There's other banks out there. You can go to your Bank of America. You can go to Wells Fargo and ask them, what is the interest rate on a high yield checking or savings account? Some banks, now here's the thing, some banks will say you have to put a certain amount in there um, to do that. Okay. So that's why I do like the SoFis and I do like Betterment. And if you guys don't have a checking account getting 3.5 to 4% interest, then send me a direct message. But you can go online right now, look up Betterment. You can look up SoFi, Wealthfront, Poppy Bank. All right. So do not keep your money somewhere where you're not getting compounding returns. All right. So let's keep it moving. Let's keep it moving. All right. And if you don't know what your tax bracket is, and I'm not even going to teach on that exactly today, I'm going to kind of touch on it. You need to know where you fall. Um, and I'm going to show you, and some people don't get this, tax rates can be as high as 50% in the next decade. And I'm going to show you why. But let's go to the second slide and show you an illustration on compounding returns and how it'll make sense in basic format. All right, so some people have seen this before, and numbers don't lie, people do. If you take a penny and you double that penny every day for 31 days, it turns into $10 million. And you can see the math here. All right. And this is just how compounding interest and compounding returns work. They don't start off big. All right. So if you have a penny on day one, it's not doing anything. And that same penny doubling doesn't really start making any momentum until about day 18. All right. But look what it does every time. It takes that same amount and doubles and doubles and doubles. All right. So you got to look at these days like years. All right. So when you're putting your money into um, market exposure, you putting it somewhere where it is doubling. You have it somewhere where it's tax free, and it's compounding in a tax free environment. And we can go into that another time. A lot of people look at the first 5 or 10 years and they say, well, Don, my money's it's not really doubling. All right. Because you have to keep your money in. And I tell people in my community and the likes that you have to look for the long range outlook of what your money's going to do. All right. So again, you want your money to compound. The first rule of money is your money compounding for you or against you. All right. So let me go back on here. I don't have any comments. If you guys have any comments, if I'm going too fast, let me know. I will be jumping on here for 30 to 45 minutes. Again, I was still up, had a client in Hawaii, and they're like a couple hours behind. It's 3 a.m. on the West Coast, Bay Area. So if you're here from the United States, let me know where you're from. It's 4:02 a.m. in Mountain Time, 5 a.m. Central, and 6 a.m. So if you're on the East Coast, or if you're watching this from another country, let me know. All right, so let's keep going. All right, now the second rule of money is the tax effect. All right, where is your money now that you have your money compounding and it's growing? All right, how much risk do you have tied to it? That's just one of the other rules that we're not going to go into tonight. And then how is it being taxed? All right, so our assets, our money falls into three taxation categories. All right, TikTok. This is my slide. So I don't want to see something pop up on my screen saying this, that, or the other, like I did the first 10 minutes. But let's keep it moving. Like I was saying before, most people keep their money in places where they're immediately getting taxed. All right. Your checking, your savings account, if you have CDs, and even if you have your money in stock market, whatever the case may be, you get a 1099 at the end of the year and you have to pay taxes on that. All right, why do we keep our money in this first bucket? We keep our money in that first bucket because it's easy to get to. But again, is that money compounding? All right. The interest rate tied to your checking savings account, the CDs, is it getting ate up by inflation or is it compounding in a direction that you want it to? All right. Most people keep their money in this first bucket here. All right. The second place where we keep our money is the tax deferred bucket. And that's typically for retirement accounts, your 401k, your 403b, 457 plan, your IRA, your SEP IRA. All right. We keep our money there to grow tax deferred, right? And then hoping at one point in the future that you pull that money out. And if it's in a good tax rate, if at that time when you retire, the taxes are good, then you did a good job. But people like myself, I'm 50 years old. If you're younger than 50, let me ask you a question. Do you think taxes are going to go up in the future or are they going to go down? Are they going to go up in the future or are they going to go down? Put a 1 in the chat if you think taxes are going to go up in the future and put a 2 in the chat if you think taxes are going to go down in the future. All right. There's really no yes or no answer. But you have to take into consideration, especially in the US, we have tremendous debt. We have the new COVID debt. We have interest on the national debt. We have Medicare, Medicaid, the defense budget. So I'm going to show you a chart that will educate you and you can make your own decisions from there. All right. But most of our retirement income is in a tax deferred bucket where it's not getting taxed now, but it will get taxed later. Right. All right. And the third bucket that most people do not have their money in It's a tax-free bucket. All right. Where do you have your money? Is it all being taxed? Most of the time it is. Is it tax deferred? Do you have just your retirement money there? Do you have anything else that besides that that's tax deferred? Most people don't. And then last but not least, a tax-free bucket. What are some tax-free things that you can look at? All right, muni bonds. The only thing about muni bonds, and again, you guys, this is for educational purposes only. If you do want some private consultation or some more information, send me a direct message. I'll send you a calendar link. We can go from there. All right. Only thing about muni bonds, if you're not in the municipality, then they're not tax free. So there you go. All right. Roth IRA, fantastic. Roth IRA is great. Only thing about the Roth IRA, if you make over a certain amount of money, I believe it's like 212,000. Don't quote me on that exactly. You guys have a phone, you have Google right there, you can look it up. But if two people together make over 212,000 or so, um, then you can't contribute to the Roth IRA. So you may start one, but then 15 years later, you can't contribute to it. Okay, so if you can contribute to a Roth IRA, if your company offers that, then you should 100% do it. All right, you can pull the money out tax free. Not going to go into that. And then last but not least, CVLI. CVLI, the big boy. What is CVLI? Does anybody on here know what CVLI? So if any of this information is making sense, if it's not making sense, let me know and we'll go back over it. If it is making sense, do your boy a favor, do your man Don P a favor, and throw some hearts in my direction. Give me some likes. Send this out to some people that don't understand the two rules of wealth building. All right, got some people in the room. We got some eyes in the room. Give me some likes if you guys understand this. All right, so let's keep it moving. CVLI is cash value life insurance. Yes, I said it. Cash value life insurance. The one component that you hear people on TikTok talking good for or against, but I want you guys to understand this. The banks are in the business of making money and they use CVLI for their tier one funds. All right. So I'm not going to go into that even more today, but if I don't tell you anything more, which bucket do you want most of your money in? Do you want it to be growing tax free? Right? Do you want it to be growing tax deferred? Huh? Or do you want it to be taxable every single year? All right. There's reasons why we have money in each of these buckets, but if you have all of your money here, then you're not even keeping up with inflation. Okay. And let's keep it moving. Does anybody have any questions before we keep going? All right. So the definitions, your assets puts money in your pocket and liabilities take money out of your pocket. Okay. All right, let's keep it moving. All right, so here's an interesting chart right here when people say, "Oh, Don, taxes aren't going to go up." Maybe they won't, but numbers don't lie, people do. And if you look here, these are the tax rates since 1913. All right, so as you can see, they were relatively low in the very beginning. But look how long taxes have been over 70%. All right. So now we're in 2026, but look how taxes have been throughout history. All right. And typically, this is when we built the infrastructure of America. So when people say taxes will never go above where they are now, based off of the history, they could. All right. So, and if you take into consideration all the debt we have, like we were saying, Social Security may or may not be around. We have all this tremendous debt. Has anybody ever gone to the US debt clock? If you've never seen it, it will scare you. Okay. Now, if you're a person of color, if you're in the black community, if you're in the Latino community, if you're from a poor white community, working class, whatever the case may be, do you think that Social Security is going to take care of the people under a certain income limit? No, if it's even there. So you have to start understanding the rules of money and applying them and start self-funding your own pension. All right. If you're self-employed, maybe you want to start a SEP, a CVLI. Okay. But again, you guys look at taxes. So saying that taxes will not go down, I mean, will go up is crazy. I mean, taxes will never go up is crazy. Okay. So the reason why it's good to understand to not have all your money taxed every year, or if you do have something tax deferred, that you also have something that's tax free. All right, because of this chart here. All right, so let's break it down. All right, so let's say you have a 401k. And again, you guys, this is not financial advice, this is financial education. Um, you have a 401k, you have an IRA, you have a self-employed pension. All right. Typically, this is where they tell us to put our money for retirement. And it's still good to be saving your money in a retirement vehicle that's doing something. It's better to be doing something than nothing. All right. But let's just say at some point you get to 100,000, you're doing a good job, right? And you're in a 25% tax bracket. You saved about 25K approximately. All right. All right. So rule of 72 again, you're getting 10% on your money, right? Every 7 years, that money's going to double every 7.2 years. All right. Now let's say you've been kicking butt, saving money, and now at one point you're in your later years, you've got $1 million in retirement. All right. If you're still in the 25% tax bracket at that time, you're going to pay approximately $250,000 of that in taxes. Okay. That's just how it is. Now, again, let's go back again. If taxes go up in the future, and I'm sorry if anybody's sending me any messages, um, I'm not, I can't see them right now, and I'll go back over them. But as you can see here, if taxes do go up in the future, say they go up to 50%, half of your money that you saved, that you worked your butt off for all those years is gone. Now, this is not 100%, of course, depending on where those taxes fall and at what points. It may not be a half a million, but you're going to pay the piper. All right. So, does it make sense to start putting your money somewhere where you're getting tax-free growth, right, in a tax-free environment that you have access to whenever you need it? All right. So a lot of times people think when they're in retirement, and I've been in this space for 23 years, right? Longer than some of you that were watching this right now. They think that when they get older, they won't have as many expenses. But what happens when you get older? Your kids are gone. You don't have those dependents anymore. You can't write them off. All right. Maybe you had that mortgage, you were writing some of that off, and your mortgage is paid up. You don't have as many expenses. I mean, you don't have as many deductions that you can deduct from, and a lot of times people go up. They end up going up in the tax bracket versus going the other way. All right, so let's look at this image B here, and if you did implement some tax-free strategies using the rule of 72, all right, and applying the tax effect, say you have a Roth IRA, all right, and this number's wrong. I know this number's wrong. Okay, this is an older slide, but bear with me. This number's like around 212 now. But anyway, so you have a Roth IRA. All right. Good job. Now, again, if you have a Roth IRA and you are making more than a certain amount, you can't contribute to it. But again, if you can get a Roth IRA, do it. All right. Or CVLI, like we were talking before, cash value life insurance. All right. Same place. At some point, you get to 100,000. All right. How much taxes are you going to pay on that 100K? Absolutely nothing. All right. When you pull that money out of the Roth IRA, how much money are you going to pay on those taxes for educational purposes? Absolutely nothing. You get to $1 million later on in your life. I don't care if the tax bracket is 50%, 30%, 40%, 25%. Some of your money, whether it's retirement or just accumulation, does not get taxed. Okay. That's powerful, people. Is the US going to save us? No, it's not. Wherever you're living at, are the higher ups going to save you? No. We have to learn these rules in this system that we're in, the matrix. All right. If you've seen the matrix, you got to be Morpheus. You have to be Neo. All right. You have to be Morpheus. You have to be Neo. Let me go back over here. So again, you guys, if you don't understand the rule of 72, it's a number equated by Albert Einstein. Let's go back to it one more time, where you can take this simple equation, and know if your money is doubling, how long it's going to take for it to double, while it's compounding, how is it being taxed in the end? All right. Does anybody have any questions on here? Looks like we have 35 eyes, no likes, no gifts. Help your boy hit that goal. Share this out to people that want to understand where their money is, why it's not compounding, and how long it will take. Again, you guys, if you don't know who I am, my name is Don Parrish, licensed insurance professional here in beautiful San Jose, California, in the Bay Area on the West Coast. Let me know where you're at. If you are on the West Coast, it is 3 a.m. right now. If you're in the mountain time, it's 4 a.m. And if you're on the East Coast, it is 6 a.m. So I wanted to jump on here, got off an appointment with some clients in Hawaii. It went longer than usual. They didn't really understand the rule of 72. We had to break it down. So I said, you know what? Let me get on TikTok and get some more information out there so people can um learn. All right, late night learn with your man Don P. All right, does anybody have any questions? All right, you guys, we do financial strategies all the time, at least twice a week. I like coming on late at night. I like to think late at night. So yeah. So yeah, again, the rule of 72, if your money is in a checking account getting 0.5 interest, take a picture of this. If you guys don't understand this, take a picture of this. Your money's getting 0.5 or 0.3 in a checking or savings account. It's going to take 144 years for your money to double if you have it in a 0.5 checking account. If you guys don't get anything from this, as soon as you get off of this live, as soon as you wake up in the morning, you need to look and see where most of your money's at. Do you have it in a checking account getting 4%? You can easily do that right now. You don't have to do anything different. All right. So let's break this down one more time, you guys, and I'm going to let you go since I'm not getting that much engagement in here. All right, like and subscribe. You guys follow me. Look at some of my videos. Learn some things outside of just life insurance. We do solutions for business owners. If you're an online business and you don't have cyber liability and don't understand it, you need to click that like and subscribe, and you'll learn some things. All right, so let's break this down again. All right, you have $10,000 and a 1%, say the bank's being nice and they're giving you a 1% interest rate, which is nothing. Most checking accounts and savings accounts, unless they're high yield, are under 1%. Okay. The bank's giving you 1%. You take the number 72 divided by 1, that equals what, people? 72. All right. That 10,000 takes 72 years to double. It's crazy. So if you have that money sitting in a checking account, you think it's safe. It is. You can go to the ATM and grab it. All right. But it's not doing nothing for you. It's not even catching up with inflation. So at least open up a checking account. You can go to SoFi online. You can go to Betterment online, Wealthfront. You can go to your own bank and ask them what requirements they have for checking, a high yield checking or savings. All right. Just by moving that 10,000 from here to here, your money doubles every 18 years versus every 72 years, which is crazy. All right. Now you understand that and you start putting your money somewhere where you're getting 8%. Typically that's stock market, 6 to 8% typically, right? Your money's doubling every 9 years. Right. And again, if you're getting a better rate of return, and let's say you're getting 12%, it's 6 years. Now here's the scary thing. All right. When banks ask us to put we open checking accounts and they have a minimum of $25 or whatever it is for their minimum. They take our minimum deposits in these point 0.5, point 0.3 checking accounts and they invest in stuff where they're getting 8, 12% and higher. All right. So if they're getting that, the same time it takes you to make 40,000 with 10,000 and a 4%, they're making 640,000. That's how they can pay us this point 0.5 because they already made they made a tremendous amount of money. Now you can apply these same things as well. Where do you have your money? Are you getting 12%? Do you have it in real estate? Hmm? Did you get lucky and buy gold back 2, 3, 4 years ago? I didn't buy gold, but I got some silver. Thank you, God, for getting silver, and it dipped a little bit, but I'm still up. Do you have your money in um, something that's making you money, or do you have it all sitting in your checking account, not doing anything for you? All right, that's the first rule of money. Is your money compounding? Right. Second rule of money. All right, is your money being what's the tax effect? How is your money now that it's compounding? How is it being taxed now? How is it being taxed later? Right. And then the third rule, and you can use these in any order. What risk do you have tied to your money? Right. Do you have it all fixed? Right. Do you have any variable exposure? Do you have any index exposure? All right. We'll go over that another time. But yeah, you guys, it was a pleasure jumping on here. I think that's all that I got for this 32 minutes. And it is getting late and I still have not been asleep. But I'm glad I jumped on here. I know someone out there got something from this. Again, you guys, if you don't know who I am, licensed insurance professional in multiple states around the U.S. Um, we help people understand what is hard to explain in layman's terms, and I'm here for you. All right. So that's all that I got for tonight. It looks like we don't have any questions at all. If you have any questions, I'm gonna stay on for a couple more seconds, and we can get to them. And thank you guys for if you're still in here, JBL, appreciate that. Alf, thank you for joining. Thank you for